Adjusting journal entries. What is an adjusting journal entry? Adjusting journal entries allow for the proper recording of revenues and expenses within accounting information systems. It is the fourth step in the accounting cycle and occurs at the end of each accounting period after the trial balance is prepared. Adjusting entries arise because of the exchange of cash does not always coincide with the earnings of revenues or the incurrence of an expense. This figure shows the classification of each scenario and what adjusting entry might go along with it. For example, if cash is received before revenue or an expense, it would be considered deferred, whereas if it was received after, it would be known as accrued. An example of a deferred revenue is if a company sells a 12-month subscription for a service on their website. Let's say the company receives $6,000 for 500 subscriptions. We would first record the transaction in a general journal as a debit of $6,000 in the cash account and a credit of $6,000 in the unearned subscriptions revenue account. Now suppose that the company prepares financial statements at the end of each month. Therefore, by the end of October, the company would have already provided 1 month's worth of service. To calculate revenue for that month, we would divide $6,000 by 12, giving us a monthly revenue of $500. This is an adjustment, and we will then record the following adjusting journal entry as a debit in the unearned subscriptions revenue account and a credit in the subscriptions revenue account, each by $500. The general rule for deferred revenues is that there should always be an increase in the liability account for the amount received. But there is an exception to that rule, where the revenue account may be credited instead. Using the same example as above, our adjusted entry will look like this, where there is a debit of 500 in the subscriptions revenue account and a credit of 500 in the unearned subscriptions revenue account. A deferred expense would be similar to a deferred revenue, but instead it deals with when a company pays for a resource instead of using or consuming it, before using or consuming it. And the general rule is that there should always be an increase in an asset account for the amount paid. Similarly, there are general rules for accrued payments. For an accrued revenue, there should be an increase in a receivable and a revenues account. For an accrued expense, there should be an increase in a payable and an expense account, for each for the amount paid. Therefore, the purpose of having adjusting entries is to record revenues and expenses that have been earned or incurred but have not been yet recorded. An important note is that these adjustments are done because of the timing of the revenue or expense being different to the time cash is exchanged. So therefore, cash will never be increased or decreased in an adjusting entry. Thank you.